Hello guys, and welcome to this class on moving averages, how they work and how you can set them on your own charts. Now I want to start by saying that moving averages are one of the most efficient, if not the most efficient indicator in technical analysis for swing trading medium to long-term positions from 1 month to 3 or for whatever long the swing lasts on the daily candles using the 20 and the 50 moving averages. This is the strategy I use and teach for swing trading, and the reason why moving averages are so efficient is because moving averages are a universal indicator which is not open to interpretation, which means the settings are what they are. Most of the traders, most of the well-known professional traders in the trading and investing industry, they use the exact same settings for the same moving averages. Therefore, there's millions and millions of eyes looking at the same chart and at the exact same lines, and will make buying or selling decisions based on these exact same lines. For example, other indicators or patterns are open to interpretation. Some traders are going to see a W pattern here, and some other traders won't see it because they use the closing price instead of the lowest. Some traders are going to see the last wave from here. This is point A, point B, and point C, and another trader are going to see the wave starting here, point A, point B, point C. Therefore, they will use and set their Fibonacci lines based on what they are seeing, because this is open to interpretation. Therefore, these indicators or patterns that are open to interpretation are not as efficient as other indicators which are universal, are the same settings, because many more people will be seeing the exact same lines and the exact same setup, and many more people will make the exact same decision. Therefore, it becomes more efficient. Hopefully this is clear what I'm trying to say here. And therefore, this is the strategy that I use for swing trading. It's all based and around moving averages. Of course, you never trade based in one single indicator. You will learn this a little bit later in the next classes. But for this class, we're going to focus on moving averages. So the way they work basically is, for example, the 20-period moving average. It will calculate the closing price of the last 20 bars, in this case 20 days, because each bar or candle, it represents 1 day. So it'll take the closing price for the past 20 days and make an average, and then set a dot here right on that average price, and it'll do the same the next day and the next day and the next day and the next day. So if you go to different time frames, if we go to the weekly time frame, the moving averages are basically doing the same, but every bar represents a week, not 1 day. So it'll take the price of the last 20 bars, which are in this case 20 weeks, the closing price of all of them, calculate the average price for those past 20 weeks, and set a dot here on the current candle, and then it'll do the same calculation the next day and the next day, and I mean the next week, the next week, the next week. And that's how these average lines form. This is the average price for the past 20 weeks in this case, and this one for the past 50 weeks, because it's set to 50-period moving averages, and it works the same in every time frame. So this is how they work. The settings that most traders will use are the 20, the 50, the 100, and the 200. For swing trading, medium to longer term positions like I do and teach, we will be focusing and using the 20 and the 50-day moving averages. As you can see, they give you a pretty accurate buy and sell signal. So here we had a buy signal when they cross bullish, and here we have a sell signal when they cross bearish. Again, you don't trade based only in moving average. You don't trade based in one single indicator. You will be looking at other indicators and price action and other factors, but you will learn that in later classes. In this one, I'm going to focus on moving averages. Now, if we use the 20 and the 50 and the 1-day candles as our main time frame for swing trading periods of whatever long the swing lasts in the one-day candles with the 20 and the 50 period moving averages. In other words, for whatever long it takes since they cross bullish to cross bearish, that's going to be our swing, our time frame for the swing, and then we will exit the position more or less here, more or less when they cross. As I said, you will be looking at other indicators at the same time, and maybe you have the chance to exit a little bit before or a little bit after sometimes. But not because the 20 and the 50 moving averages are our main moving averages. That doesn't mean we're not going to be looking at the 100 and 200 day moving averages. This is going to help us estimate where the bottom could be, and if the long-term trend for the specific market is broken or not. As you can see now, the price is holding on the 200-day moving averages. If this line breaks down, then we're almost guaranteed to be in a bear market, and it might last longer. So we will use the 100 and 200 to try and estimate what's going on with the longer term trend of this specific asset, even when we are out of our position already. That's all for this lesson. I will see you soon in the next class. Bye for now.